Stock market crashes are inevitable. It's a simple fact of investing that at some point a correction must happen, and it's a cautionary tale as old as the very first investors. However, it's up to you whether it's seen as a horror story or a fairy tale. In today's video, we'll be tackling how to prepare and actually capitalize on a stock market crash and show you the real reason why investors are either made or broken during these times.
We'll have to go through our ups and downs, and certainly with valuations where they are right now, I'm sure we're going to go through a doozy of a correction this year.
A market crash has been the talking point of most investors for the last year, and for good reason. Stocks are trading hot, stocks are overvalued, and the volume the market is seeing right now is genuinely chaotic. But the story is the same every time the market crashes, and history tends to repeat itself. So how do you prepare for the stock market crash? It's simple, you don't. You don't want to accept the crash, you want to embrace it. And these tricks and tips really get you on the way to capitalizing on the stock market crash where others simply do not. It might sound simple to some, but this tip is disregarded time and time again. And when it comes to the point where you need it, it won't be there. Having spare cash in your investing account isn't bad. In fact, having it there is possibly the safest place it can be when dealing with the stock market. One of my qualms with a lot of the general market consensus is that if your money isn't 100% invested, you're losing out, and that's just simply untrue. An entirely invested portfolio has no way to deal with corrections or take advantage of them. To theorycraft this for the newer investor and explain what a healthy cash pile looks like, you want at least 10% of your entire portfolio at all times, disregarding a market crash for the moment, to be cash or cashable stocks, for example swing trades that can be dialed back into your cash pile at any time. This money gives you the freedom in the idea that in any circumstance you can capitalize on a stock correction. Let's say you're invested in Tattooed Chef at $20 and the stock falls to $15 off of some random news that you can't explain. You can use that cash pile to then average down on that position and make it more lucrative in the long term. Now, take this idea and double to triple it in times where the market consensus is that there is going to be a correction or a crash incoming. A 20 to 30% chunk of your portfolio being free-flowing cash to work with is how investors come out the other end of a crash in an incredibly good position. If you have a $10,000 portfolio and $3,000 of that is in a cash pile, you can average down in the event of a market crash in almost every stock you own. And when the market rebounds like it always does, you will have incredible averages for the future to then capitalize on. Don't ever underestimate the power of having free-flowing cash. In its most simple form, the money that isn't in the stock market will be there to help you when the stock market trips up over itself, and that's invaluable. The absolute number one tip that everyone will give you when the market starts to slip is do not sell. And it's amazing advice, but no one actually tells you why you shouldn't sell. As a newer investor, or hell, even an experienced investor, seeing red days in stocks you own really doesn't feel great. And if in a crash your whole portfolio turns red and you see those negative percentages rack up, it can start to worry you and make your fight or flight reaction turn on. Being told not to sell is no use if you don't know why, and this is what I'll explain. So why isn't it you shouldn't sell? Well, it's simple. A stock crash, correction or bearish market is temporary and lasts on average around 1/8 of the time of a bullish market, where most stocks are rising. On average, a crash is experienced and then back to normal within a year. And we have seen with the Corona mini crash that it took an even shorter amount of time to normalize most stocks. But what does this mean? Well, if you sell, not only do you lose 41% of your initial investment, on average from the decline in the market, but you lose the potential 480% gain in the market rebound. Selling at a loss is one mistake, but seeing the market rebound past where you initially bought in and skyrocket is the real kick in the teeth. You cannot time the market, and if you believe you can time the market, you will invariably miss out on some of the biggest and best days within the market from trying to. A study by JP Morgan revealed that if you invested $10,000 within the S&P 500 between 1999 and 2008, you'd have made around $30,000. A skittish investor, however, who tried to time the market and missed 15 days a year would only make $15,000. And an investor who missed 30 days a year would end with a net loss of around $4,000, leaving them with $6,000. This is why we mentioned buying on the way down rather than selling, as buying more shares in the red lets you average down for the rebound rather than losing it all and missing the rebound. You should be doing this anyway, but evaluating overvalued stocks during skeptical times is an incredible thing to do. Knowing that a stock is overvalued lets you reel it back in because, quite frankly, it's chosen to run before it can walk. And during times that have a lot of talk about crashes, these stocks being reeled in and realizing the profit in them can make a world of difference if a crash does in fact happen. History teaches us that a stock market crash is almost completely finished and moving upwards in a matter of weeks or months. The 1987 crash rebounded almost instantaneously, and this is more reason why not to sell, but is the perfect reason to make some changes to your portfolio. As an example, I recently made a video on ABML in which we spoke about the huge run-up they experienced, but we also spoke about how insanely overvalued they are due to multiple factors such as not having built a manufacturing plant yet, and basically not having a functioning product. Because of how overvalued they were, I decided to sell a third of my position at their all-time high and let the price correct itself in the future, as it should, because it's being overvalued. Taking profits on overvalued stocks shouldn't be seen as a negative, rather the opposite. You're profiting from a stock trading too hot too soon, and you can average up much better when it corrects. But what relation does this have to a crash? Well, overvalued stocks hit the hardest during crashes, and quite honestly, they are the ones that take the longest to recover. You'll notice that every tip that I've given you applies both for crashes and everyday investing, and for good reason. A good investor will already incorporate these tips in everyday trading life, but an incredible investor will be able to apply them within a crash and profit from them. My last piece of advice is just an add-on to what should be in every investor's portfolio. A great community in which to learn and grow their knowledge and share both great days, bad days, and consolidate in the in-between. Being a part of a like-minded community can teach you things you never knew, let you teach others things they don't know, and collaborate on doing research into companies. It truly lets you grow with people and access all kinds of knowledge you never knew. I may be biased, but I'll say it. I strongly believe the free Discord me and a couple other friends made is one of the best places for this at the moment. Myself and my partners publish weekly reports and guides, host all sorts of discussions, and most of all help and assist you grow your knowledge on investing and growing your wealth. We don't ask for anything in return, and any skill levels are appreciated, so come say hi and dig into some of our guides and company reports. Once again, I hope you all enjoyed the video. I decided to make this my topic this week because a lot of talk is being had about crashes and corrections, and yet no one is giving a straight answer to newer investors on how to handle one. As always, if you want to know anything or if you have any requests, just pick my brains in the comments, or even better, say hi in the Discord. If you'd be so inclined, leave a like and subscribe, and for now it's DD-Bae signing off.